Welcome to Pro News Weekly. Let's dive into the weekly updates on the financial markets. The US dollar continued to fall this week, although at a slower pace than last week. The dollar index DXY fell to 105.4 on Friday, its lowest level since the 12th of November. The dollar has thus entered a deeper correction, falling below support, as 76.4% of the entire rally from the late September lows has come under pressure from market forces. At the forefront of these factors was a reassessment of interest rate expectations. By the end of the week, the market was pricing in an almost 90% chance of a cut in December, up from 66% a week earlier. The latest boost came from the U.S. employment data. Payrolls showed 227,000 new jobs, just above the expected 218,000. This data is firmly in economic growth territory. But what caught our eye was the rise in the unemployment rate to 4.2%. This comes on the heels of a 355,000 drop in employment in November after a 368,000 drop earlier, according to an estimate based on a household survey. Technically, the dollar has the potential to fall 0.8 to 1.2% and still remain in a corrective pattern. A deeper dip would raise the question of a change in trend. However, we will only talk about it if the dollar index fixes below the 104.5 to 105.0 area after the inflation and Fed rate decisions in the coming weeks. The US S&P 500 and NASDAQ 100 were moving up into the territory of historical highs in a somewhat routine manner. Having stepped into the territory of historic highs on Monday and hovering there for some time, these two indices continued their smoother rise. The S&P 500 was on the verge of breaking above the 6,100 level, but has yet to make a decisive move. It's easy to see where buyers are coming from. This index has climbed 28% since the start of the year and has grown by over 20% in each of the last 2 years. This is one of the best performances in history if we exclude the years of recovery growth after failures. The NASDAQ 100 climbed to 21,500, adding 30% since the beginning of the year. Interestingly, the leading driver remained AI hopes, but it would hardly be wise to write off the strong macroeconomy, lower interest rates, and speculation around tax cuts. Both factors favor growth companies. That said, the VIX Volatility Index has fallen back to levels at the start of the year and 5 years ago. Volatility depression is often associated with the calm before the storm. However, we can only discuss it when the VIX falls below 10 versus the current range between 13 and 14. The measured rise cools sentiment, causing the fear and greed index to decline. It has fallen from 67 to 56 over the week and is already almost in neutral territory, leaving room for acceleration. Gold moved in a range of less than 2%, spending most of the week just below $2,450 per troy ounce. That's almost 2 weeks of fluctuating in a narrow range, slightly pointing upwards. The price has been slow to bounce back after the late November collapse and remains below the 50-day moving average. It is quite possible that during the recent lull, the bears are gaining liquidity for a new attempt to crash the price, as they did at the end of October and when they stopped the price climb at the beginning of last week. Bitcoin has surpassed the psychologically important 100,000 level and stabilized above 102,000 USD. It took almost 2 weeks to cross this level, during which altcoins became the market driver. Powell, the head of the Fed, called Bitcoin the digital analog of gold, which was taken as a bullish signal. Automatic stop orders also pulled the market up in thin trading in Asia. It looks like the next important mark for cryptocurrency markets could be $4,000 for Ethereum. It was not possible to consolidate above this level earlier this year. The coming week is likely to be the last fireworks show for the markets, as it is overloaded with major central bank decisions and several landmark economic publications. On Monday, we will monitor inflation in China, where consumer prices slowed to 0.3% year-over-year in October. Last time, producer prices showed a 2.9% decline, remaining in negative territory for the last 25 months. Tuesday will start with a decision on the Reserve Bank of Australia rate, which is at a 12-year high of 4.35% for over a year. The average analyst's forecast doesn't suggest a cut this time either. However, all G10 bloc colleagues are actively cutting rates. Will we see, if not a cut, at least a hint of one? On Wednesday, U.S. consumer inflation will be released. The reversal of annual rates to growth, Trump's rise to power, and strong macroeconomic data have fueled doubts in the Fed about the need for further aggressive rate cuts. These statistics will be crucial for the last Fed rate decision of the year on 18 December. Also, on Wednesday, the Bank of Canada will decide the rate. There, the rate was cut from 5.00% to 3.75% in 6 months. The last move in November was by 50 points at once. The multi-year lows of the Canadian dollar may force the BOC to reduce the rate step or take a pause. Thursday is the Swiss National Bank's key rate decision. This happens once a quarter, and the 3 previous meetings this year have ended with a cut. The latest market forecasts indicate a 70% probability of a 50-point cut from the current 1%. Also on Thursday is the ECB key rate decision, which is now at 3.4% versus 4.5% at the peak of the cycle. Reductions are due to cuts and revisions of spreads between other key rates. The most likely scenario is a cut of another 25 pips to 3.15%. Equally important will be the comments at the subsequent press conference. Keep an eye on the euro, which, pricing 1.05 to USD, is walking on the edge of the cliff. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.